third webinar on insurance today. And you know, everyone hates insurance except me. I love insurance, which I'm going to have a really fun time teaching to you today or talking about to you today. So you'll probably see my arms flailing and me getting all excited, and which I guess kind of makes me what, a sadist, because you guys hate it, but I love teaching it to you. So, all right. So without any further ado, why don't we go through some housekeeping things? And again, for those of you who have sat through many of these webinars, you just enjoy the picture here. So if you have not been to one of our webinars before, welcome. You were able to make it, so yay. What you should be seeing on your screen right now, the bulk of your screen should be this teeny little so-called car, the PowerPoint, and on the bottom right-hand corner is me. Hello. And you will also see on the left side, there are some icons, and you have, there's a couple things there. There's a little kind of talk bubble there, and then there's a little question mark bubble. So as we go through this, please feel free to type in your comments or questions. I will check both bubbles in the end to make sure I got everyone's questions, but I would just ask if you guys could just type it in that little chat icon. That might be easier than they can all be in the same spot. But feel free to type them in as you go. I see we have an insurance agent. Awesome, welcome. So that's great. So we are, oh, sorry, a couple more things, sorry. You do get a CMCA credit for this, 1 credit. If you need it, we will email the credits out to you. No need for you to do anything. You should see them in the next day or so. As soon as we get our report back from our provider that says kind of who was on and how long they stayed on, and we can confirm that you were here, we will email you your certificate. What other thing? If you have questions, not questions about what I'm talking about, but questions as far as the IT side goes, you're having difficulty connecting, you can't hear me, anything like that, please don't type it into the questions, because I don't know anything about IT and there's nothing I can do on my side. What you can do, however, is call our phenomenal education guru, Sean, at 303-991-2076. That's his direct number. Call him and he can hopefully help you through any technological issues you are having. You can also email him at education@altitude.law. All right. Okay, so now without any further ado, let's get started talking about what I love, and which is very near and dear to my heart. And I don't know why. I just, like, ever since I started practicing in the HOA world, loved insurance, loved talking about it, loved teaching it, and certainly loved talking with insurance professionals about it, because I always learn something new. So I'm going to try and get down to the very, very basics with this presentation. Insurance is complicated. People get confused by it. Of course, not insurance agents, but most people, normal people, right? They get confused by it. It's hard to understand. It's hard to weed through. Insurance policies can be very confusing. And, you know, every year I try to do at least one class on insurance to kind of remind people of the basics. Certainly, there are a lot of kind of underlying factors that we're not going to talk about today. We're just going to talk about the basics. But this is exactly the reason why you need a professional insurance broker who is proficient in HOA insurance, especially, who can help you with all kind of the little nitty-gritty things, or hopefully they just don't come up because they're already taken care of. But it is important to know, in general, what insurance is, how it works, what our HOAs need. So let's talk a little bit about what insurance is. Well, you can read that for yourself. I underlined what I think are the important things to remember. An insurance policy is a contract. It's like any other contract you enter into with vendors. The terms are specified by whatever is contained in the document. The purpose of the contract is really to transfer risk. And what does that mean? Well, it basically means we know that not even if, it's a question of when, something's going to happen that is either going to cause property damage in the community, is somebody's going to get upset with us and want to sue us, or something along those lines. And we know that it's inevitable. It's going to happen at some point. It's probably going to happen more than once. So what does this transfer of risk do? Well, it essentially is a form of guarantee that you don't have to put any money out of your own pockets to deal with this situation. Now, of course, there's always the deductible, and that is money that comes out of the association's pocket, right? But besides the deductible, insurance really protects our pocketbooks, because we all know that paying attorneys to defend you in court, oh my God, we're so expensive, right? Why is that? I don't know. Attorneys are expensive. Rebuilding your property, if there's a fire that burns down half the community, that's expensive. And these are not the types of expenditures that associations just have money sitting in their accounts for, right? Easily could bankrupt a community if everything had to get paid out of pocket. So this contract protects our pocketbook from having to be tapped whenever we have a loss caused by a specified event or peril. That's the other big thing, specified event or peril. So if something could happen and perhaps it's covered by insurance because it is a specified event or peril, or perhaps it doesn't. It isn't. The way I've been told from insurance brokers that I've talked to is essentially, well, everything's going to be covered except what's excluded. So for that reason, it's really important to know what our exclusion section says, because there are a lot of standard exclusions in property policies or other types of policies. And sometimes you can get endorsements, so it's additional coverage to be able to cover yourself for that, and sometimes you can't. So again, the biggest example I can give you of an event that is not covered by insurance is wear and tear, right? If your roof caves in because it's that old and you haven't been maintaining it, it's very doubtful that insurance is going to come in and pay to repair or replace that roof if you've neglected it, okay? So let's move on. Let's talk about these things here. We just talked about why have insurance, right? By law. You manage or sit on the board of a community created after July 1, 1992, which is when our statute, Kiowa, came into existence. So if you are a post-1992 community, you are bound by all the insurance requirements that Kiowa has. If you are not, if you were created before July 1 of 1992, then you're bound by everything that your governing documents require. And the statute doesn't actually apply to you with respect to insurance, but it's definitely good guidance. And we talked about really why we need it. We need to protect the property. We need to protect our financial assets, the pocketbooks. We got to protect the association from financial disaster. That's why we need it. Okay, so when I talk about insurance for associations, there are certainly many facets of it, but I really want to focus on the three primary types that we deal with. We deal with property/hazard, same thing, liability, and fidelity policy. Now, there are things that go kind of under each one of these. And as you can see, I've outlined a couple under liability, and we'll talk about all of these different types of coverages here soon. But in the meantime, I just want you to know that there really are kind of three primary buckets, so to speak, of insurance coverage: property policy, the liability, and the fidelity. Let's talk about property. What must be covered? So what must be covered is whatever your declaration requires. I can't tell you how many times I've had very upset boards calling me and saying, why do we have to, insure this if we don't own it? And the answer is, well, because your documents say you do. It doesn't matter if you own it or not. Now, of course, the default, if you have nothing in your documents about who has to insure what, obviously the default is you own it, you insure it. That is a provision in Kiowa, and that is common law. If you own it, it's yours. You got to take care of it. So the association, for example, if the documents are completely silent, will always be insuring the common area, whatever that encompasses. Homeowners will always be insuring their property that they own. Again, unless we have something to the contrary in the declaration. So again, you're going to insure whatever the declaration requires. The association is going to insure whatever it owns. Common elements. Now, Kiowa says, right, all common elements have to be insured by the association. So in this case, if you are a post-Kiowa community, so remember, after July 1, 1992, if you're a post-Kiowa community and you have a set of documents that say, for example, you're a condominium community, you have limited common element balconies, and the declaration says homeowners must insure their balconies, well, that's not valid, and that's a void requirement, because Kiowa requires associations to insure the common elements. You can't get around it. You have to insure all the common elements. That includes the limited common elements. But wait, there's more, right? That's not enough. Kiowa also says you have to insure the condominium units. If we're talking about a stacked condominium community where you got units on top of each other, the statute says, association, we don't care what your documents say, you've got to insure the unit, except you can exclude finished surfaces and owner upgrades. What are finished surfaces? So that would be your carpeting, your hardwood floorings, the paint, wallpaper, paneling, and owner upgrades. So to the extent that you have a condominium unit with, let's just say you've got the lighting fixtures in there, you've got countertops, and that's all original install. It's never been upgraded. Those are all insured by the association. Those are not going to be insured by the homeowners, even if the governing documents say they are, if you were created post 1992. Okay, so those are important things to remember. And I have run into several sets of documents that were after 1992 that did try to push that insurance obligation onto the homeowners. And, nobody knew any better. And so that's what the association was doing. But that is contrary to what the law requires. And it takes just one attorney looking at the statute or one smart homeowner looking at the statute to say, you're doing it wrong. You're violating what the statute says. All right. What else is required when we talk about getting property insurance? Okay. Well, we are talking about full replacement value. And these are requirements for post-Kiowa communities. If your community is pre-1992, you can tune out, but I wouldn't, because you never know. The way things have been going, more and more provisions of Kiowa are being made applicable to communities that were created before Kiowa. So at some point, these provisions will likely be applicable to all communities, but they're not right now. So full replacement value minus deductible. That basically means whatever the cost is to replace something, that's the total you got to insure for. I had an association once that they had a really fancy, really expensive, it was like a clubhouse, so to speak, and it was really expensive to insure it. And they said, well, why don't we just insure it for like 70% of the value, and then we will fund the rest of it through our reserves. And I said, well, you can't really do that because Kiowa requires full replacement value. So unless you're saying we're going to have a deductible equal to 30%, which you can't really do anyway, you can't really insure for anything less than full replacement value. Insurance proceeds must be used for repairs. Okay, this is kind of a biggie because I have seen quite often situations where the association gets a whole bunch of insurance money and the homeowner, there's damage to a unit on the inside, and the homeowner says, I want to do this myself. I want to get my own contractor to fix the interior of my unit. Just give me the money and I'll use it to pay my contractor. And there's associations that are like, okay, sign this release and we'll give you the money. Well, if you're post 92, you can't really do that because Kiowa says insurance proceeds must first be used for repairs. And then it specifically says at the end that you cannot distribute proceeds to homeowners unless there is a surplus. In other words, you've paid for all the repairs and there's still money left over. When does that happen? Never, right? So technically, those proceeds that the association receives from the policy, they have to be used to pay the contractors. So how does that work if a homeowner says, well, I want to hire my own contractor and have my own contractor do the work? Well, first of all, the board has to be okay with that because in most cases, it's the association that's going to, pick the contractor. But if you say, fine, homeowner, get your own contractor, you're still not giving the money to the homeowner. You can either have the homeowner pay the contract and then reimburse the homeowner, or you can have the homeowner submit the invoice and then you can pay the invoice directly. However you choose to do it is up to you, but I would still have some sort of an agreement in place with that homeowner, because if you're saying, pick your own contractor and then we'll pay them directly, we got to account for all the things that can go wrong, which is, well, let's say the contractor does a bad job and then they cause damage to other portions of the property or neighboring units. We need to make sure the association is not going to be on the hook for that. What if the contractor says, oh, you know what, I found some more damage, so now it's going to cost this much, and they add like $5,000 to the price. Again, the homeowner is going to come to us and say, give me more money, and we're going to say, no, we've only allocated, X dollars for your unit. So these are all things that have to be determined ahead of time. If you're going to allow the homeowner to be involved in the repair process. And, sometimes it makes sense to do that. Sometimes it doesn't, depending on what's, damaged. But I would be very careful about having a homeowner kind of be in charge of that without some sort of an agreement in place, making it very clear kind of where the limitations are. And then association policy is primary. So what this means is if we have an overlap in coverage where the association insures the unit, right? Post-Kiowa community, we insure the unit. Homeowner gets extra coverage or thinks he's supposed to have particular kind of coverage and insures the unit as well. So let's say there's damage to the drywall and the association's insurance covers that damage, as does the homeowner's insurance. I cannot tell you how many times I have seen boards say, oh, you got to submit a claim, homeowner, submit the claim. It's especially if it causes negligence, right? The homeowner, they go to sleep and forget to put their cigarette out. Well, that causes a fire, which causes damage to that unit only. And then the board's like, well, we're not submitting a claim for your negligence, silly homeowner. Why would we do that? It's your fault. And the answer is, that's wrong. First of all, the association's policy is going to be primary, which means policy limits have to be exhausted in our policy before the homeowner's insurance policy is going to kick in. Second of all, and we may as well talk about this now, that if you insure it as the association and it is damaged, it is whatever we're talking about, the unit, okay, that makes it easier. The homeowner's, the condominium unit is damaged because the homeowner did something stupid. It doesn't matter. If we insure it and it's an insurable event that has happened, so usually a fire is going to be an insurable event, there is a duty on the part of the association to submit a claim. Now, if the total damages are less than the deductible, that might be a reason not to. But if it's more than the deductible, you need to submit a claim. What happens if you don't? Well, then the association better be paying out of pocket anything that would have been covered by the insurance policy. The reason we have to submit a claim is if a fire is covered, it doesn't matter what the cause of the fire was. So a lot of times I get a lot of pushback on this because I'll have boards tell me, Alina, it's the homeowner's fault. They were stupid. And I then ask the association, the board, well, who pays for this policy? Well, the association does. Okay, but where does the association get its money? Well, the homeowners pay their assessments. Oh, so the homeowners then pay for the policy, right? Well, yeah, I guess they do. Well, Iowa considers this the homeowner's policy, not an association's policy, just so you know. And it requires homeowners to all be named insureds in the policy. It's their policy because they pay for it. Now, they share it collectively. So if one homeowner is negligent and that means we have to submit a claim, then the other homeowners are obviously going to suffer from that if our premium goes up because we submitted another claim. But that's what they agree to when they buy into the community. The other thing is, why do we even have insurance? Well, half the time it's to protect ourselves from our own stupidity, right? Think about your car insurance. We all have our car insurance. Well, if I'm driving and I rear end the guy in front of me because I'm not paying attention and I'm texting, not that I would really do that, right? No, but hypothetically I'm texting, I rear end the guy in front of me, and now my insurance is going to pay to fix his car. My insurance is going to pay to fix my car, even though I was the stupid one, right? But that's why I have insurance. It's because I'm stupid and I'm going to hit someone and I don't want to pay out of pocket. My insurance is going to pay to fix both cars. Is my insurance then going to come to me and say, Alina, pay us back? No, because that's why I'm paying the premium, right? It's to protect me from my own stupidity, which is exactly the same analysis we use with homeowners in the HOA's property policy. The homeowners are paying for the policy to protect themselves from their own stupidity and any damage they may cause to the property. Okay, now there's other things that could happen to the property, wind, hail, rain, whatever. But if the damage comes from the stupidity of an owner, it doesn't matter. The analysis is the same. We still have to submit the claim. All right. We have some, by no means is this an exhaustive list. I once taught an hour-and-a-half class that just talked about the various exclusions in insurance policies. So don't think that this is kind of the end-all be-all. These are just some typical exclusions in property policies that you're going to see. So groundwater, and that's really, when the water floods and it comes from the ground. It's interesting because if you've got a really bad thunderstorm and you've got water, it's coming and it's blowing to the side of the building and it breaks the window and causes damage inside your home because it broke the window and it got everything wet and soaked, that is something that would typically be covered under your property policy. However, once the water hits the ground, right, it hits the ground and then it flows into your unit and causes water damage, at that point it's considered groundwater and it's not going to be covered. So will flood insurance help that? Possibly. But as it stands, groundwater is a typical exclusion. Demolition. I always have fun with this one. So, you know, if a building or a community is more than, I think it's 50% destroyed, maybe it's less even than that, then a lot of times you have to rebuild. So let's just deal with one building. You have a high-rise condominium building, it has a fire, 50% destroyed. It's in Denver. Denver says you got to rebuild the whole thing because you can't really repair it at this point. You got to tear the thing down. Okay, so, you know, we're going to submit a claim to our insurance for property, and we're going to say, you know, cover this. It's a fire. It's a covered loss. We need you to rebuild. And insurance is going to say, okay, no problem. Oh, by the way, though, we got to come in now and demolish the rest of your building, and that's not really covered. Okay. Debris removal. Once we demolish the rest of the building, we got to haul all that debris away from the site before we can start rebuilding. Yeah, that's not covered either. These are all standard exclusions, but the good news is they are typically covered through policy endorsements, which I am almost positive you guys all have, because every insurance agent I've ever worked with, they get these for their associations. But again, it's you know, kind of part of the package, but it's still an additional cost. Code compliance and increased cost of construction. So if you have an older building that was constructed, let's say 30 years ago, building code was different then than it is now. And what may have complied at that time with building code, that type of construction typically is not going to comply any longer. So if you have a situation where you do have to demolish and rebuild, then you are going to have to rebuild up to current code. You can't rebuild to the way the code was when the building was first constructed. You're gonna have to do it, you know, so it meets current code requirements. And that increases the cost of construction. And that is an exclusion. Increased cost due to code compliance, cost of construction. Again, this is something you should have an endorsement for, but it is a standard exclusion. Accounts receivable, your building burns down and you as an association cannot collect assessments for a year while everything's getting rebuilt. That's accounts receivable. How are you going to get anything done? How are you going to pay your insurance costs? How are you going to pay other bills that come in the door that are still coming, even though the building's being rebuilt? If you don't have an accounts receivable coverage in place, you're not going to be able to do it. So again, this usually comes through an endorsement as well. Some policies I think may actually cover it without an endorsement, but it's a pretty standard exclusion in most property policies. So again, you should have an endorsement for that. Things like foundations, so the concrete. Foundations are excluded from coverage. I have asked several insurance brokers if there is any kind of an endorsement that someone can get to cover foundations, and I've been told pretty much no. So that is, like I said, a pretty standard thing. Foundations don't get impacted by fires. The only thing really that's going to impact a foundation is what, ground movement, earthquake, that sort of a thing. All right. Okay, I'm going to move on to liability now. CGL stands for Commercial General Liability. That's how we refer to the liability, the general liability policy. So what does it do? Well, So the biggest difference between a liability policy and a property policy is property just protects the property damage because of a specified event. Liability protects the association from damages resulting from wrongdoing or being accused of doing something wrong. So it would include, defending the association in a lawsuit where a homeowner sues because we didn't allow them to put up their ginormous treehouse, okay? We get sued. So they could say we were damaged because maybe financially because we already bought all the materials, or we were damaged mentally because now our children can't play in the treehouse. I mean, there's all sorts of things that people come up with. But the key with the liability policy is it really has to allege that the association did something wrong, whether it's negligent, whether it was willful, whether it was an action or an inaction. Something has to be alleged along those lines. And the most common example, of this type of coverage really is the old slip and fall, right? I slipped on the ice. I'm suing the association because you didn't remove the ice like you should have. You didn't remove the snow. Never mind that it was a north-facing surface and I should know better. That doesn't matter, right? I'm going to sue you because I slipped and fell. And so that's kind of the liability policy and what it protects against. It has to relate to the association's ownership, existence, use, or management, which it almost always does. Like with the example of the slip and fall, you didn't properly maintain the common element sidewalk, right? You own that sidewalk. You didn't maintain it. So it's pretty standard. That part is almost always satisfied. So who is covered under a liability policy? Well, most of the time when we see lawsuits, the association is named, the corporation. It's standard. But there are times when others are named in a lawsuit. Who? Well, the individual board members, officers, the president, vice president, the manager and management company. Have you seen that happen before? I bet you have. And committee members, sometimes even individual homeowners, or anyone really who represents the association or is an agent of the association. All those folks can get named. I've seen lots of cases with directors and managers being named. So all these individuals have to be covered under the policy. I shouldn't say have to be, they should be covered under the policy. My understanding is community managers, most of you require that in your management agreements, and rightfully so, I'd probably require it as well. So those are the folks who are covered because they're the ones who are going to get accused of wrongdoing. If you have anything to do with the management of an association, at some point someone's going to get upset with you and they're going to accuse you of horrible things. They're going to accuse you of stealing money from the association. They're going to accuse you of plotting against the homeowners. I mean, especially this past year, I have heard some crazy stuff. But, I think everyone's gone a little nutty this year anyway. But these are all the folks who need to be covered in a CGL policy. Most policies do cover these folks. If you're not sure if your policy does, obviously you should be able to talk to your insurance professional, whoever your community works with, and have them confirm that those are all covered individuals. By the way, this meme is hilarious. I love it. It made me laugh. It made me snort a little bit, but you never heard that. All right. Let's talk about some typical exceptions from liability policies. Discrimination, contract disputes, auto liability, workers' comp, web extended liability, and failure to obtain adequate insurance. Let me go through these one by one. So discrimination is exactly what it sounds like, right? You discriminated against me. You enforced the covenants against me because I am fill in that blank. Never mind the fact that you don't even know what I look like or who I am, and my name doesn't give anything away, you still discriminate against me. People love throwing discrimination allegations out there. If they're unhappy with something you're doing, you are discriminating. Sometimes they don't even know why you're discriminating or what, kind of category they fall into, if any, but you're still discriminating. So discrimination, associations get accused of that all the time. And some policies will cover claims for discrimination, others excluded. I do believe you can get additional coverage to cover discrimination. So if you're not sure, again, if your policy has that, you need to reach out to your insurance professional and confirm that. Contract disputes. This is something I really want to drive home, because we've all been in situations where a board is not happy with the performance of a contractor and basically says, well, we're not paying this contractor. This landscaper didn't do what they were supposed to do. We don't like how they did it. Whatever it is, they don't deserve to get paid. We are not paying them. We're holding the check. So, the contractor has several options, one of which is they can certainly file a lawsuit against the association to try and collect the money that is owed to them. That's a contract dispute. You owe us money under the contract. We say we don't. Most policies do not protect against contract disputes. What that means is they will not pay an attorney to defend an association in a lawsuit where a contractor alleges that they are owed money. Okay. Some policies will pay to defend an association in this type of claim. A lot don't, but I don't believe there is any policy out there that it's ever going to pay damages. So to the extent that you're sued as an HOA by a contractor, you lose, and the contractor says, the judge says, association, pay this contractor the remaining $10,000 on their contract. Insurance isn't going to pay that. Why? Well, because if it was that easy to get out of your contracts, all you'd have to do is enter into contracts and never pay them, and insurance will always pay on your contracts. That's not what insurance is for. So contract disputes are typically excluded. I have, had associations, I always tell them when they get into a tiff with their contractor, check with your insurance agent. See if you have any coverage when it comes to contract disputes, because if you don't, it is not worth it usually to move forward in any shape or form, because you're going to spend more money defending yourself than anything you could save on the contract. Not worth it. Okay. Auto liability. This is another one that sometimes people push back on. So there's owned and non-owned auto liability, and that basically is, let's say we are back to holding physical meetings and the board in a community decides we're going to hold our meeting offsite at the local Starbucks. If you have to drive there, one of the board members is driving there, they accidentally hit someone while they're driving, and now there are damages to be paid. And what I usually get back from people is, yeah, but that driver, that board member has car insurance. They have their own auto insurance. That should cover them. Well, it might cover them originally, but that insurer is going to turn around and come back after the association to get reimbursed, because that board member was acting in the scope of his duty as a board member when he was driving. And therefore, it really becomes an association issue. Okay? So you got to be careful. And if an association doesn't have an automobile coverage, then it will not be protected for something like that. Now, owned and non-owned, that simply means, does the association have association-owned vehicles that people use, or are people driving their own vehicles for association business? That's all that means. Workers' comp, this is one where also get some pushback because most associations do not have employees, and they say, why do we need a workers' comp policy when we don't have workers? The answer is this. If you have contractors on your property doing work, you should have workers' comp, because in Colorado, if you have an underinsured contractor, they don't carry enough workers' comp, or they let it lapse during the time they perform the work, and someone gets injured on the job, if they cannot get workers' comp coverage through their employer, the contractor, they can legally go after the association for coverage. And if you don't have a policy, you may still end up owing them, even though you don't have a policy. So you should always have the policy if you have any contractors, and especially if you have employees. Web extended liability. For those of you who have websites, for those of you who have Facebook pages, whatever it is, at some point you're going to put something on there that might upset someone. Whether it's a homeowner who feels that you put something on there about them and now you have slandered them and they want to sue, versus an owner that feels that what you put up is offensive and discriminatory. Whatever it is, if they sue you over the content of what was on that website, you are not going to be covered through your liability policy, because that's an exclusion and you really need to have web extended liability endorsement. And finally, failure to obtain adequate insurance. This one doesn't come up very often, but I know it's going to rear its ugly head, and everybody needs to be aware of that. With insurance premiums going up and up and up, everyone's trying to save money right now. And one of the ways associations save money is they say, we're going to have a higher deductible, because that saves on premiums. That makes sense, right? But there can be a situation where an association essentially has a premium that is high enough that a homeowner could say, you know what, you're not really covering my unit like you're supposed to, because the deductible is so high, I'm never going to have damages unless my whole unit burns down that's going to meet the deductible threshold. So essentially, I am self-insuring the unit, even though you're supposed to be insuring an association. And therefore, you have failed to obtain adequate insurance, and I'm going to sue you over this, because you need to have a lower deductible. That can happen, and that type of claim is typically excluded from coverage. Just FYI. So when you guys are thinking about increasing the deductible amount, be very careful with that, because this is out there. And just because we haven't seen it or you haven't seen it yet, doesn't mean it's not coming. All right, D&O, directors and officers. So this is also a liability policy. In other words, it has to come from wrongdoing. And it covers really protections for claims against specific board members, directors, officers who have been accused of committing some sort of a negligent, wrongful act or omission. I have seen many times where, there's a fine line between whether something falls under your D&O coverage versus your CGL, general liability coverage. And I've seen both policies kind of pointing fingers at each other, saying it's yours, no, it's yours, and they kind of fight over it. What I typically say is, I don't care as long as somebody covers it, so you better figure it out between the two of you. So again, if you have directors and officers personally named in lawsuits, and again, allegations of wrongdoing, it may be a D&O claim, and so we always say submit it to liability and to D&O. And it's the same people who are protected as the ones who were protected in the previous discussion. And then there's the umbrella policy. Again, it's pretty much what it sounds like. It's an umbrella. It kind of goes over the regular policy, and it'll kick in if you exhaust your policy limits. So basically, if you have a $2 million liability policy, it's pretty typical, and you get sued for a slip and fall, and the jury awards $4 million. This actually happened years and years ago. So jury awarded $4 million. Association had a $2 million limit on its liability policy. If that association had an umbrella policy, umbrella would have kicked in and paid the remaining $2 million. That association, however, did not have an umbrella policy. So it was, had issues. You don't ever want to be that association. It's not worth the risk. My understanding is umbrella coverage is relatively inexpensive compared to everything else, you're paying for. And you should have it. You'll probably never need it if you have it, but if you don't have it, you will need it. That's how it works, right? So 5 million, 10 million, pretty standard on an umbrella policy. Fidelity. So that's essentially theft of funds, okay? We've seen it, right? We've all seen it, associations who get money stolen from them. One thing I do want to mention is that a true fidelity policy, like if you went to an insurance broker who didn't do anything with HOAs and you said, I want a fidelity policy, what they're going to give you is a policy that covers theft of funds by your employees. That's what it truly is. As associations, we can have our funds stolen from much more. Most of us don't even have employees, right? We can have it stolen from anyone, by anyone, anyone who has access to the funds. And so for an association, a fidelity policy covers more than just theft by employees. It covers basically anyone who has access to the funds. I have seen this go sour for associations. Years ago, there was a community, they had money stolen by an employee of a management company. They submitted a claim to their fidelity policy. Fidelity policy said, well, you're only protected for theft by your employees. This is not your employee. This is your agent's employee, and therefore you're not covered. So be careful with that. Like I said, insurance brokers who specialize in HOA, they know better. So make sure when you are working with your insurance brokers that they do work with HOAs so they know exactly what you need. If you're not sure if you have the correct policy, you can always ask your broker to confirm that this is you've got this coverage. What's required? This is Kiowa. So again, if you are pre-92, you can do whatever you want here. But Kiowa requires an aggregate 2 months of current assessments that are calculated from the current budget. So whatever you would bring in a 2-month period under your budget, and whatever you have in reserves at the beginning of that year. So that is the minimum amount that you need to have fidelity coverage for. You can be higher if you want. It just can't be lower than that. Okay. All right. Of special note, and I think we touched upon a lot of this already, but Kiowa says you, the association, can adopt written, non-discriminatory policies that address how claims can be submitted to insurance, who has to pay the deductibles, and further it says, oh, and by the way, whether or not you have a policy, you can still assess the deductible to negligent owners who caused the damage. Okay, so that's all good. For communities that are created post-1992, I cannot tell you enough that you need to have a deductible policy in place. Why? Because there is language in Kiowa that strongly implies that unless you have a policy to the contrary, that the association is responsible for paying the deductible on its claims. Okay? And if you don't have a deductible policy spelling out who has to pay the deductible, there's a very good chance it's going to be the association. So I know there are at least a couple of insurance agents out there right now who deal with the HOA insurance side that are religiously recommending to their boards that they adopt these types of deductible policies. I think that's a great idea, and I also would encourage you, especially if you were created after 1992, your community, in other words, to have a policy like this in place. It really can save you a lot of heartache down the road. As far as I get questions, how do we know we have good coverage? How do we know we're adequately protected? That's when I say, look, you got to talk to your insurance broker. You've got to talk to your insurance professional. They should be able to tell you all of this. Now, the other thing you can do, and what a lot of, I think, HOA law firms will do, is they'll provide, or they can prepare for you, I should say, an insurance audit. And an insurance audit is basically a review of your current policies and all the endorsements. I don't mean just like the cover page that has a summary. I'm talking about the entire set of policies, all 500 pages of it. Yay, fun. And they will prepare a report basically saying, you know, does this comply with the legal requirements and the law? Does this comply with what your governing documents require? Is there anything like that's missing from a legal standpoint? Is there anything you can do to improve your coverage? So again, it's more of a legal analysis that then you could use to take back to your insurance professional and say, hey, have we looked at these things? So again, that is something that's out there as well. Insurance audits for me are super fun. Most people hate doing them. I love doing them. So definitely that's another option. And kind of another thing I've seen help is maintenance and insurance charts. I know law firms prepare those as well. So that would just set forth who has to insure and maintain what components in the community. And I know a lot of times that helps. You can give that to your insurance agent. It's really a legal opinion in the form of a chart that basically says, here's all the things the association has to insure. And then that is used by the insurance agent to make sure the association has adequate coverage, at least for property. So those are kind of things that are available, that are out there. And I know I had to do it. I'm sorry. I had to do it. I hope you're all laughing because I think it's hilarious. And borderline inappropriate, but still hilarious. All right. So with that, let me go down the list and see if I can get to all the questions in here. We do have a few minutes left. Is it the insurance company's responsibility to ensure the requirements of the decks? Well, technically what you're going to be told is, and what I hear insurance brokers say is, the insurance will insure whatever is required to be insured by your declaration. So they're not going to list each component out. What's going to happen is if there's a claim, they're going to pull out the declaration and say, okay, so this is insured, this is insured, this is insured. Problem is that the declaration is a legal document, and sometimes it's really difficult to tell what has to be insured, which is why I was saying the maintenance chart can be very helpful to insurance agents, because then they can see exactly what needs to be insured. Some HOA boards and members believe that a special assessment for any reason is covered by the insurance company under loss assessment, even if it's for upgrades and maintenance, i.e. roofs. My understanding is that loss assessment coverage is only for a loss. This issue seems to crop up every year. Have you heard this before? I have heard it before. And it's been my experience that it really depends on each individual homeowner's coverage. There are different types of loss assessment coverage, depending on who the insurance provider is, depending on how savvy the homeowner's insurance agent is. And sometimes they require, that it have the word loss in the letter. Sometimes they say you can't have the word deductible. Other times they say you have to have the word deductible. And so it's not a one answer. And no matter what an association does, it's always going to have some homeowners whose insurers are going to deny the claim. And unfortunately, that's just the reality of it right now. There are so many different kinds of policies. I typically will recommend for homeowners that they sit down with their insurance agents and get a really good grasp on what is covered and isn't covered by the loss assessment. And if they're not happy with it, to shop elsewhere. Can you help a property manager know how to handle a minor water damage between units when it's not enough for a claim? Should each owner fix their own property and the HOA, and does the HOA have to be involved? So unfortunately, the answer is it depends. Us lawyers love saying it depends, but it really does, because it's going to depend on what is in their governing documents. Sometimes it'll be pretty clear, and we can say, yes, it should be the homeowner. Other times it's not clear at all. And other times it's kind of like, well, who would be responsible for the deductible? Do you have a policy in place? So there's a lot of what ifs there, but we've certainly addressed these types of questions quite often for, specific circumstances where managers have contacted us. If an HOA files a claim, receives the checks, but doesn't cash them, the board now elects to absorb the expenses. Can the HOA, 1, return the checks to the insurance company, and 2, expect there not to be a ding on their loss history report? So my understanding, and again, I would check with your insurance professional on this one, my understanding that is anytime you submit a claim, that's a ding, whether anything gets paid out or not, because it does require an investigation. And so even if at the end, the conclusion is this is not a covered loss, or we're not paying anything because it's under the deductible, my understanding is there's always going to be some kind of a ding once you submit that claim. So I don't know that sending money back is necessarily going to be helpful to anyone. But again, I think I would absolutely check with your insurance professional on that one. Is there a case where the association's carrier could or would subrogate against the homeowner or the management company? If you are managing a community that is post-Kiowa, they're not allowed to subrogate. That's one of the things Kiowa says that we didn't talk about today, but it does say they're not allowed to subrogate against any homeowners or insureds under the policy. So the answer is no. If it's a pre-Kiowa community, you would, I would hope they wouldn't either, because it's, like I said, the homeowner's policy, but then you'd have to read the policy in some detail to see what's in there. In a CGL policy, do the covered parties need to be named? They don't need to be named as far as, Bob Smith, Jane Doe. You don't have to have specific names or the name of the management company, but there needs to be a generic description. So usually it'll say managing agent, directors, officers, volunteers, but it doesn't have to say specific names. Seeking clarity. Post-Kiowa HOA, owner or HOA responsibility for plumbing expenses or to repair, service, or replace a pipe or valve that services one unit to the exclusion of all others. The location of the pipe is behind the drywall within the condo. Location of a zone valve provided water to one unit is located above the ceiling tiles, 3rd floor, common element hallway. This is another one. It's going to depend on a lot of things. If you, as far as insurance goes, any of the pipes, water lines in a stacked condominium community are to be insured by the association under Kiowa. So if this is going to be an insurance claim, this is a claim the association would have to make. As far as, repairs, if it's not an insurance claim, that's going to have to depend on what the documents specifically say. Does D&O cover management company and their employees? It should, just like the liability policy, it should cover. all those folks. Let's see. Last question. If an HOA is responsible for snow removal contract is in place for a 3-inch threshold, but 1 inch of snowfall creates ice, owner falls. Typically, this is covered by insurance, but since it is under the threshold, would this put the HOA at a liability risk, or is this under the insurance? Well, so insurance is going to cover usually the defense for these types of claims, and whether or not the judge is going to say the association did something wrong is going to be irrelevant as far as whether or not you have coverage. So I would always say submit a claim because insurance should cover you kind of one way or the other. Can an HOA require owners to carry loss assessment coverage for wind hail deductible? If it's in the declaration, you can require it. I highly discourage any associations from doing that, because then if a homeowner doesn't carry it, we are at some point responsible and liable because we didn't properly enforce our restrictions and covenants requiring them to have it. So I would never want to put an HOA in that kind of a situation. And it's 1 o'clock. You guys, thanks so much. My email's here if you need to email me with any additional questions. Just remember, I love insurance, so it's all good. Thank you for joining us. We will see you soon, and keep an eye out for those certificates. Thanks.